All right, folks, if you jumped into crypto last year thinking you'd be the next Satoshi,
and now it's tax season and you're stressing like your MetaMask just got hacked, don't worry, we've got you covered.
whether you bought Bitcoin once or became a full-time Solana degenerate, this is your crypto tax survival guide for 2025.
Because tax season is here, and spoiler alert, crypto has its own rules. Confusing? Absolutely, but not impossible to figure out.
Let's break it down. How the IRS sees crypto, what counts as taxable, and how you can keep your business out of trouble. If you like these kinds of videos, make sure to like and subscribe. Your support helps us create more videos like this.
How the IRS classifies crypto. First things first, the IRS doesn't treat crypto like traditional money. It's not the same as cash or a checking account balance.
Instead, the IRS treats crypto like property, just like stocks or real estate. That means anytime you sell, spend, trade, or exchange your crypto, you might trigger a taxable event.
And it's not just the big trades. Think about this. Even accepting a $25 payment in crypto for a sandwich, that could be taxable.
Exactly. So it's important to track everything. Every little transaction could matter when it comes time to file.
Accepting crypto as a business. If you accept crypto as a payment for your business, say a customer paid you $100 in Solana for a catering gig, you have to report that as income. Even if you didn't convert it to cash right away, it's still income the moment it hits your wallet.
And let's say you hold on to that crypto for a few months and the value goes up. If you decide to sell it later, that creates a capital gain. And you'll owe taxes on the profit between the time you received it and when you sold it.
That's right. So if you're in a business that accepts crypto, every transaction can have multiple tax implications. One for income and another for capital gains when you sell.
And remember, you need to track both your income and capital gains from crypto sales, even if you never cash it out into dollars. What is and isn't taxable?
So let's dive into the big question. What counts as taxable and what doesn't?
Here's what is taxable in a nutshell. Number 1, accepting crypto as payment. That's income. Number 2, selling crypto for fiat, such as euros or dollars. That's a capital gain or loss. Number 3, trading one crypto for another. Yes, even swapping Bitcoin for Ethereum or swapping tokens on an exchange. Number 4, spending crypto. Using it to buy goods, services, or pay bills is treated like spending property. Number 5, earning crypto through mining, staking, or airdrops. That's income too.
Example, let's say you mine Bitcoin that's worth $500. You have to report that $500 as income, even if you didn't sell it yet. It's considered income the day you received it.
And here's the stuff that isn't taxable. Number 1, buying crypto with US dollars and just holding it. Number 2, transferring crypto between your own wallets or exchanges as long as you're not selling or trading it. And number 3, moving crypto into a cold wallet or different platform. Just a transfer, not taxable.
As long as you're not selling or trading and you're just moving things around, you're usually in the clear. Short-term versus long-term gains.
Here's where things get a little tricky. If you sell crypto less than a year after buying it, it's considered a short-term gain, and it's taxed at your regular income rate, which can go as high as 37% depending on your income.
But hold it for over a year and you get the benefit of long-term capital gains, which is taxed at a much lower rate, either 0%, 15%, or 20%, depending on your income.
That's a big difference. For example, let's say you bought XRP at $1 and then sold it at $3. If you held it less than a year, you'll pay the higher short-term rate on that $2 gain. But if you wait just a few extra days and hold it over a year, you could qualify for the long-term capital gains tax, saving you a ton of money.
It might feel like you're just waiting for a couple of days, but trust us, it can save you hundreds, if not thousands, in taxes.
How to track everything. Now let's talk about tracking. Keeping good records is essential. Every time you receive, sell, trade, or convert crypto, you want to log a few key things. Now let's talk about tracking. Keeping good records is essential. Every time you receive, sell, trade, or convert crypto, you want to log a few key things.
Number 1, the date of the transaction.
Number 2, the type of crypto involved.
Number 3, the market value at the time of the transaction.
Number 4, your cost basis or what you originally paid for it.
Let's be real. Manual spreadsheets, they work if you've got just a couple of transactions. But if you're actively trading, staking, or mining, use a tracking tool. Trust me, you don't want to do this manually.
Exactly. Tools like CoinTracker, Coinly, or TaxBit are built for this. They'll make your life a whole lot easier when it's time to file.
And remember, if your accountant doesn't know what a gas fee is, it's time to find a new one. Seriously.
What happens if you don't report? Here's the kicker. The IRS now directly asks on Form 1040, did you buy, sell, receive, or trade any cryptocurrency this year?
And exchanges like Coinbase and Binance report your transactions directly to the IRS. So if you're hiding crypto activity, the IRS will likely know. It's not a good idea.
Failing to report your crypto transactions could lead to penalties, interest, or worse, criminal charges in extreme cases, so don't risk it. Now, when it comes time to file, make sure you check with your exchange. No matter which one you use, they'll send you a tax document that reflects your activity for the year. Whether it's a 1099-B, a 1099 MISC, or something else, you want to make sure you've got that form to report your gains and losses correctly.
Those forms are super important. They'll help you understand what your taxable income is and how much you owe. Don't forget, just because the exchange sends you a form doesn't mean you're off the hook for reporting everything. Double check your records and make sure they match up. Crypto can be an incredible opportunity. Whether you're a business owner, a trader, or just holding for long-term gains, you've got to handle it correctly.
Track every transaction, separate business from personal, report everything accurately, and use the right tools to make tax time easier.
And if you're unsure about anything, reach out to a CPA who understands crypto. It could save you a lot of headaches and a lot of money.
I'm Chai.
And I'm Grace.
And
we'll see you next time with more exciting small business news.
Believe in small business.